Today, we embark on a riveting exploration into the enthralling world of high dividend yield companies set to shape the financial landscape in the promising year of 2024. Join us as we delve deep into the intricacies and nuances of each company, unraveling their potential and positioning them as key players in the investment arena. For more videos on the best stocks to buy, go press the like button and subscribe. With that being said, I say let's jump straight into today's story. In the bustling landscape of high dividend yield investments, Petrobras, a stalwart in the integrated oil and gas industry, beckons investors with a rich history dating back to 1953. Headquartered in Rio de Janeiro, the Brazilian giant has built a workforce of 45,149, steering the energy narrative in the region. What makes Petrobras an intriguing prospect is its alluring dividend yield of 9.80%, a tempting proposition for income-focused investors. Delving into the financials, Petrobras stands undervalued with a P/E-gap ratio of 4.01, a staggering 62.80% below the sector median. The undervaluation story deepens as the non-gap ratio of 4.16 sits 49.56% below its 5-year average. Yet, this seemingly attractive investment comes with a caveat. The Brazilian real's volatility poses a currency risk that could impact investments adversely. Furthermore, concerns arise regarding the security of Petrobras' dividends. The specter of a possible dividend cut looms, presenting a significant risk for investors. Prudent risk management strategies recommend limiting exposure to Petrobras to a maximum of 3% of the overall investment portfolio. While the allure of high dividends is magnetic, a balanced approach ensures that potential downsides are mitigated, safeguarding investor interests in the volatile energy sector. Now, let's step into the world of culinary delights with Kraft Heinz, where dividends are served with a side of undervaluation. This iconic company, renowned for its delectable offerings, currently entices shareholders with a dividend yield of 4.61%. What adds to the appeal is the relatively low payout ratio of 52.63%, signaling sustainability in dividend payments. The financial feast continues with a free cash flow yield of 5.89%, painting a favorable risk-reward profile. Valuation metrics tell a compelling story. A P/E-gap ratio of 13.69, standing 25.99% below the sector median and 46.39% below its 5-year average. Seeking Alpha's profitability grades further elevates Kraft Heinz's charm, showcasing EBIT and net income margins above sector medians. This culinary giant not only satisfies the palate, but also offers investors a recipe for success, combining attractive dividends with a promising growth outlook. Kraft Heinz emerges as an appetizing prospect, where financial metrics blend seamlessly with iconic products, creating a delectable investment proposition. Next, we will embark on a journey through the financial seas with Allianz, a German insurance powerhouse with a legacy of financial health. Holding a Moody's Aa2 credit rating, Allianz boasts a P/E ratio of 11.61, hovering slightly above the sector median. However, the real allure lies in its dividend yield of 4.99%, significantly surpassing the sector median. Allianz's appeal extends beyond dividends to growth, evident in its dividend growth rate of 6.33%. With a dividend payout ratio of 55.88%, the company showcases a commitment to maintaining a secure dividend in the years to come. The 24M beta factor of 0.73 adds a layer of portfolio diversification, reducing volatility. Balancing attractiveness in valuation, dividend income, and growth, Allianz emerges as a potential candidate for the Dividend Income Accelerator portfolio. This German giant not only navigates financial waters with precision, but also offers investors a compass for steady income and growth. In the tempest of market fluctuations, AT&T stands resilient, offering investors a robust dividend yield of 6.81%. Despite facing headwinds, the company reveals a silver lining with a compelling free cash flow yield of 16.44%. The financial forecast remains favorable with a P/E ratio of 7.49, significantly below its 5-year average. Seeking Alpha's factor grades affirm AT&T's attractiveness, with an A+ for profitability and a B+ for valuation. However, a cautious tone emerges given the company's limited growth potential. The recommendation suggests underweighting AT&T in a long-term oriented investment portfolio. For our next pick, we will navigate the investment landscape with United Parcel Service, a logistics giant presenting a compelling case for the Dividend Income Accelerator portfolio. UPS not only delivers packages, but also dividends, with a dividend yield of 4.26% and an impressive 3-year dividend growth rate of 17.06%. Profitability takes center stage with a return on equity of 47.35%, coupled with an attractive valuation boasting a P/E ratio of 18.48, a noteworthy 12.74% below the sector median. Projections into the future, with EPS estimates for the coming years, paint a picture of continued prosperity. Investors seeking a balance of dividend income and growth might find UPS to be an optimal choice, leveraging its competitive advantages and strong financial metrics. Over in the world of pharmaceuticals, Pfizer emerges as a prescription for robust dividends. With a dividend yield of 5.45%, Pfizer outshines competitors like Johnson & Johnson and Merck & Company. The prescription for stability extends to Pfizer's financial health, evident in its higher 3-year revenue growth rate and 3-year EBIT growth rate. A dividend growth rate of 4.43% and a payout ratio of 56.79% underline Pfizer's commitment to sustaining dividends. The valuation narrative remains fair, with a PE non-GAAP ratio in line with the sector median. For investors seeking stability and dividends, Pfizer offers a compelling proposition, combining pharmaceutical prowess with consistent income. Next, let's step into the annals of history with Altria, a company with a legacy dating back to 1822. Beyond its historical significance, Altria offers investors a blend of dividend income and growth. With a PE ratio of 9.28 and a high dividend yield of 9.20%, Altria stands as an attractive pick. EPS estimates projecting steady growth further underscore Altria's potential as a reliable income generator. The company's 53 consecutive years of dividend growth add a layer of confidence for investors seeking stability and long-term dividend growth. Altria, with its timeless legacy, emerges as an excellent choice for those navigating the landscape of dividend income and growth. Next up, if we look at the towering skyline of finance, Morgan Stanley stands tall, offering investors a dividend yield of 4.33%. The financial narrative unfolds with a payout ratio of 55.11%, coupled with an impressive 3-year dividend growth rate of 32.41%. Revenue estimates projecting steady growth underscore Morgan Stanley's potential to provide investors with a steadily increasing income stream. However, amidst the allure, caution is advised. Comparative analysis with Bank of America and JP Morgan reveals nuances in terms of dividend security, profitability, and valuation. Morgan Stanley beckons to dividend income enthusiasts, yet investors seeking a balance of valuation and profitability might explore alternatives in the financial landscape. Over in the world of connectivity, Verizon stands as a bridge between technology and dividends. Despite a negative performance in the past 5 years, Verizon allures with a high dividend yield of 7.04% and a relatively low valuation, reflected in a PE ratio of 8.63. A strong profitability, with a return on equity of 22.56% and a moderate payout ratio of 54.41% positions Verizon as a potential addition to the dividend income accelerator portfolio. However, caution is advised, especially for investors exposed to Verizon, as concentration risk looms large. In conclusion, these 9 high dividend yield companies offer not just investments but immersive adventures in the dynamic world of finance. The narrative weaves through undervalued gems, savory financial recipes, international landscapes, and pharmaceutical giants, providing investors with a diverse palette of opportunities. Each company contributes a unique chapter to the financial story, blending risk, reward, and potential in an intricate tapestry. It's not merely an investment, it's a strategic journey where each paragraph adds depth to the financial narrative, inviting investors to navigate the exciting twists and turns in the world of finance. For more videos on the top stocks to buy now, please go press the like button and subscribe. With that being said, I wish you the best of luck and happy investing.